Is this market dip a trap or the biggest buying opportunity of the entire year? In the next few minutes, I'm going to show you why one of Wall Street's biggest bulls, Tom Lee, is convinced we are about to see a massive market rally in the next 90 days. I'll give you two specific stocks he is betting on to ride this wave. What we just saw was a classic purge. Big players flushed out all the leveraged positions, the people betting with borrowed money. Now that the market is clean, institutions are buying back in with both hands. This isn't just a hunch, it's a pattern we've seen before, and it signals a market bottom. So why the extreme optimism? Tom Lee argues that there will be no recession in the United States. Why? Because companies have low debt, and households have also cleaned up their finances. The foundation of the economy is solid. Now, you might be thinking, what about the massive government debt? That's a real issue, but it doesn't cause a financial crisis. It causes inflation. And the best hedges against inflation have always been equities, real estate, and commodities. The real story is that we are entering the fourth quarter, historically the most bullish period of the year. Institutions that have missed the rally so far will be forced to buy aggressively to salvage their annual performance. And where is the money going to come from? Trillions are sitting in money market funds. As interest rates begin to fall, that cash will flood into the stock market. The Federal Reserve is essentially adding gasoline to the fire. So where do you put your money? The recovery of the real economy will be the main catalyst. This means two sectors are poised to benefit the most: small companies and financial firms. Let's start with the big banks. Look at Goldman Sachs. Its investment banking business is set to explode as more companies go public and M&A activity picks up. The stock is attractively valued, and Tom Lee sees significant growth in its earnings per share. This is a clear bet on economic recovery, and it's not the only one. Morgan Stanley and JP Morgan are in a similar position. If you want to stay ahead of these institutional moves and get analysis like this before everyone else, make sure you're subscribed to the channel. It's free and it's the best way to support this work. Now for the second idea, a company you might not know, Sodexo. Sodexo is a leader in food services and facilities management. Think corporate cafeterias, university dining halls, and hospital services. This is a real economy business. The stock is currently deeply undervalued compared to its main competitors, Compass Group and Aramark. Sodexo has huge competitive advantages and is a market leader, yet it's trading at a historically low valuation. As people return to offices and events, Sodexo is perfectly positioned to benefit. Now, let's talk about China. Banks are screaming, "Buy China now," especially for a short-term trade, as Trump softens his rhetoric. But you have to be careful. Take a company like BILI, great growth, but huge regulatory risk. It could even be delisted from U.S. exchanges. A smart way to play China while managing risk is to buy Chinese stocks listed in other markets, like Hong Kong or Switzerland, to diversify away from the US dollar and Nasdaq risk. And all of this connects to why Bitcoin is acting like digital gold, which I'll tell you more about right now. The recent market panic proved something critical. Bitcoin acted as a safe haven asset. While other cryptos plunged, Bitcoin held strong. This reinforces its role as digital gold. Let's be clear, the crypto market isn't fair. It's like the Wild West. When the price dipped, institutions like BlackRock reportedly bought 45,000 Bitcoin at the bottom. They create the panic, buy your assets for cheap, and ride the wave back up. The system is broken. Money printing will continue, which is why liquidity keeps rising and assets keep getting more expensive. Bitcoin is now expected to reach over $200,000. So the conclusion is simple. We are in a bull market. The recent drop was a buying opportunity, not the start of a crash. The trend is up, fueled by a flood of liquidity. My strategy is not to fight the market, but to understand its currents and sail with them. Follow the institutional money into financials like Goldman Sachs and undervalued recovery plays like Sodexo. The key is to adapt, not to fight the current. Subscribe so you don't miss the next update. Now I want to hear from you. Are you buying this dip with conviction, or are you staying on the sidelines? Let me know in the comments.